So what we have to do is endure the reckoning. And I think we're in the reckoning. I think the gold price in the last 18 months, well, really the last 24 months, is really indicative of the fact that the reckoning is really and truly upon us. There's two ways out for the United States. One would be an honest default, which is where you say to the bondholders, yes, we realize we owe you $37 trillion, but we don't have it. And you say to the Medicare and Medicaid recipients, the Social Security recipients, say some old codger like Rick Rule, yeah, you paid in for 60 years. That's right. We understand, but there's no money. So we're going to renege on part of our promises. That honest default isn't going to happen. We're in the midst of a dishonest default, where we honor the nominal value of our obligations to our bondholders and to entitlement recipients, but we inflate away the net present value. My belief is that over the next 10 years, in an absolute sense, the US dollar will lose 75% of its purchasing power. Not in a relative sense. I don't think that the US dollar will do badly against the pound, against the sterling, against the Canadian dollar, against the Australian dollar. Countries that have the same circumstance, but maybe less resilience than the United States. But I do believe that in an absolute sense, the US dollar loses 75% of its purchasing power. That's a consequence of the fact that we've lived beyond our means for 40 or 45 years. The gold price, I think, is a reflection of that.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back a very popular guest, Rick Rule. So Rick is the former president and CEO of Sprott US Holdings with decades of experience in the commodities business. So Rick, thanks so much for coming back on the podcast.
Always a pleasure, Anthony. Thank you for having me back.
No problem. Looking forward to the conversation. A lot's been happening. You were saying before we got on that you've had some, I guess, sort of controversial takes, at least for a lot of people who are in the industry. So I'm sure we'll get to that at some point. But I really like to start our interviews very broad. So what are you currently seeing in the economy and markets at the moment?
You know, the economy, I would suggest, is mixed. I'm referring in particular to the U.S. economy. There's some self-inflicted wounds, of course, around tariffs. The underlying economy is not bad. It is, in fact, good for people who have really, truly marketable skills. Unfortunately, a lot of American society doesn't have marketable skills. The softness we're seeing in certain commodities, in particular oil and gas, suggests that the overall economy is not as strong as people would have it. And it's been a very long time since we had a recession. This is not a call because I'm not an economist. I would merely state that one would expect the oil and the gas price to be higher relative to production plateaus in the US were the overall economy strong. I note, too, that despite the relative strength in the US economy, that there's a lot of political pressure in the United States to cut interest rates, which is an odd thing to do with CPI stated inflation fairly stout, and the overall economy is very strong. It speaks to the politicization of the US economy. And I think that this inflation and this politicization on top of the debt and deficits experienced in the US and in other countries is an easy way to explain and an accurate way to explain the incredible strength that we've seen in the gold and gold equities markets this year.
Okay, really interesting. If we stay on the sort of US economy, so it sounds like, yeah, we've got a lot of unemployment data, which has been, I guess basically removing jobs that have sort of apparently appeared last year, the year before. It seems to be revision after revision after revision. Do you think this is just an issue with how they measure the jobs, or do you think this is actually economic sort of contraction?
I think there's problems with regards to measurement, both around jobs, but also around inflation. I think the CPI is a silly index. But I note that I live in a small town in northwestern Washington, a very small town, and there's a genuine labor shortage of people who will work hard and show up to work. The reason that there's a labor shortage is that the price of goods and services in the last 15 years has escalated so much that people are sort of quitting. The minimum wage here is, I don't know, $7.70 an hour or something. That's not a living wage. So there's a disconnect between what uh, skill sets people have and how they can afford to be compensated relative to the level of utility that they generate and their cost of living. There's a fairly ugly dichotomy, and that needs to be addressed in our economy.
Yeah, so you think it's sort of a pushback to, I guess, yeah, I think labor being rewarded, and yeah, I guess that's what's going to happen with the demand dynamics. There's not enough labor. You need these
Yep.
people to work. They're going to get more wages, high
Well,
wages.
we could do a 40-minute segment on just that, probably of interest to you and I, but nobody else. We have an economy in the U.S. where the tax code and legislation has favored consumption for 40 years over production. The consequence of that is that our educational system has become consumer focused, which is to say, we study things like basket weaving that have no net present value. And at the same time, our tax code penalizes investment. What that means is that many people in our labor force have neither the skills nor the access to capital that would generate the higher utility that would allow higher wages. Think about the difference in productivity between a ditch digger who uses a pick and a shovel and a ditch digger who uses a piece of equipment from Caterpillar tractor. The guy who uses the pick and shovel probably generates $7 or $8 worth of utility an hour, measured by the amount of dirt that he or she moves. That same person, once they acquire the skills to use a front end loader or a back hoe, generates enough utility that they can be paid $35 or $40 an hour through the application of capital. As the U.S. society has become consumer oriented, the educating people in the skills necessary to employ capital has been de-emphasized at the same time that the tax code has penalized the employer for buying that piece of equipment in terms of depreciation schedules relative to other countries. This takes a long time to turn around, but this is the heart of our dilemma.
Yeah, and it seems to be something they're trying to change. So if you look at, this is looking at another part of, I guess, monetary policy and the economy. You used to send dollars overseas, and foreign people would invest in sort of equities or in bonds. But now it seems like there's a push for them to sort of directly invest in the economy, and we're seeing that mainly in AI, but also manufacturing. Is that what you see? Do you think that's what the sort of the Trump administration is going to do, and do you think that's going to benefit, as you said, the labor market?
I think the Trump administration, like prior administrations, is trying to get elected. I don't think they care particularly about the future of the country 10 years or 20 years from now. What they care about is putting themselves in a position to allocate treasure in the next 12 months. If I sound cynical, it's because I'm cynical. I don't see any difference between the Democrats and the Republicans. What I do see is countries around the world that have a recent experience with being stupid becoming smart. If you and I were to build a factory in the United States, a tilt-up concrete building, we would be able to depreciate that factory on our taxes, at least the construction part of that factory, in a straight line over either 30 or 33 years. In other countries that are more investment focused, say China, we wouldn't depreciate that building. We would expense it in year one. This lowers tax receipts from people who are investors, but it equips the economy with the capital necessary to grow. It equips the workers with access to capital to become more efficient. It allows the kind of increases in real workers' wages that we've seen in China over the last 30 years. It's odd that a communist country has enough freedom of investment that they have seen really rapid increase in real incomes benefiting 500 million people over 30 years, while the capitalist society has become consumption oriented, where real workers' wages have fallen for 30 years. An interesting dichotomy explained away simply by looking at the tax code.
Yeah, and I guess with a lot of the how does a lot of the AI investments are being depreciated over 3 years? That's what they're saying. So how does that then impact it?
Uh, some AI investment is expensed, and AI is all about replacing workers who don't have the ability to compete with mechanization. If you are one of those few high-quality AI programmers, you are making wages that make the NBA look parsimonious. We are in a society that will increasingly reward skills and utility as opposed to effort. There's no way around this. What AI will do is it will allow us to generate utility with less upfront capital investment, which the United States is going to need because the United States, with regards to things like entitlement liabilities and on balance sheet debt, has consumed a lot of the capital that would otherwise have to be invested in capital goods in order to sustain our economic growth. AI will reduce the necessity for capital investment in other sectors at the expense of workers who don't have the educational level to keep up.
Yeah, and it seems like tech sort of swallowed the world and swallowed, I guess, the U.S. economy, and it seems like AI is going to be the next thing that does that, and it sort of sucks the capital and the money from seems like a lot of the other parts of the economy.
Well, we'll see. I actually am beginning to believe that some of the hype around AI is overstated. I need to say that I say that without knowing very much. My expertise is in natural resources and conventional financial services, not in technology. I do know that whenever the world has become enamored with the latest, greatest thing, that sector's hype gets priced higher than its reality. And some of the furor around AI is beginning to remind me of the dot-com boom. I'm not smart enough to tell you where the misallocations of capital are taking place. I can only tell you that when something is as popular in terms of narrative as AI, it is likely that it's attracting unsophisticated capital in stupid amounts.
Yeah, okay, really interesting. But it sounds like for the average American worker and I guess Western worker to benefit, you want the economy should shift away from a consumption-led economy to back to an investment-led economy.
Which isn't going to happen, sadly. So what we have to do is endure the reckoning. And I think we're in the reckoning. I think the gold price in the last 18 months, well, really the last 24 months, is really indicative of the fact that the reckoning is really and truly upon us. Let's look at it arithmetically. The on balance sheet liabilities of the US government, and I'm not going to talk about other economies, which are in mostly worse shape, but the on balance sheet of the US liabilities, pardon me, of the US federal government, not state and local government, exceed $37 trillion. And that's the number that the naysayers focus on. But the truth is worse. The off balance sheet liabilities of the US government, represented by entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions, that number is estimated by the Congressional Budget Office at $120 trillion. Now, to put that $120 trillion in perspective, uh, gross federal income at the United States, revenue into the federal government from all sources, before they do anything like pay salaries or bomb foreign countries or whatever it is they do, is only $5 trillion. So you're trying to satisfy an obligation with a net present value, not a nominal value, a net present value of $120 trillion on gross income of $5 trillion before other expenditures. That doesn't work. There's two ways out for the United States. One would be an honest default, which is where you say to the bondholders, yes, we realize we owe you $37 trillion, but we don't have it. And you say to the Medicare and Medicaid recipients, the Social Security recipients, say some old codger like Rick Rule, yeah, you paid in for 60 years. That's right. We understand, but there's no money. So we're going to renege on part of our promises. That honest default isn't going to happen. We're in the midst of a dishonest default where we honor the nominal value of our obligations to our bondholders and to entitlement recipients, but we inflate away the net present value. My belief is that over the next 10 years, in an absolute sense, the US dollar will lose 75% of its purchasing power. Not in a relative sense. I don't think that the US dollar will do badly against the pound, against the sterling, against the Canadian dollar, against the Australian dollar. Countries that have the same circumstance, but maybe less resilience than the United States. But I do believe that in an absolute sense, the US dollar loses 75% of its purchasing power. That's a consequence of the fact that we've lived beyond our means for 40 or 45 years. The gold price, I think, is a reflection of that. I'm not certain that the gold price, which has risen in nominal terms from $253 an ounce in the year 2000 to some number exceeding $3,700 today, I'm not certain in a real sense that the gold price is up at all, but in a nominal sense in US dollars is up 9% compounded. I would suggest to you that as a consequence of our society living beyond its means, that the increase in the gold price represents the deterioration in the purchasing power of the US dollar, represented by the deterioration in confidence that US and foreign savers have in the integrity of the US dollar.
Yeah. So it's just a shift away from, as you said, US dollar to these wealth preservation assets. Because I guess if you look at it, gold is, you know, or the dollar has depreciated against gold close to 50% over the last 3 years. And it seems
Right.
like you think that's going to continue.
Or, frankly, people don't take note of this. I would suggest that gold's march began in the year 2000, not in 2022 or 2023. Remember that 25 years ago, gold was at $250 an ounce. Gold has increased at 9% compounded for 25 years, which is to say that gold, at least in nominal terms, has done its job.
Yeah, I'm not sure if you look into liquidity and sort of, I guess a lot of commentators say that there's increased liquidity or increased, I guess, of 8 to 9% annually. So it seems like, as you said, it's done its job. It's basically just kept you at the same wealth levels or relative wealth levels where you were in 2000.
Correct. And I think that represents the sort of mirror image of the performance of the US dollar as a store of value.
Okay, so that seems to, as you said, it looks like it's accelerating. It looks like there's going to be a shift away from um, bonds and to gold and the dollar to gold. And it sounds like you think this is going to continue quite aggressively into the coming year. So this isn't like we're at the top of the bull run, we're at the top of this super cycle. You think it's going to continue?
If people ask me what would cause me to sell my gold, I say a cessation of the problem. If I saw uh, some chance of a balanced budget in the US, by the way, the budget is in excess of $2 trillion in deficit today, or if I saw the ability for a political resolution of the entitlement liability, or if I saw positive real interest rates in the United States. By positive real interest rates, I mean an interest rate on the US 10-year Treasury that was in excess of the rate of the deterioration of the purchasing power of the US dollar, then I'd sell my gold. I believe that while the official statistics around inflation, the CPI, suggests that inflation as defined by the US government is running by 2.9% a year, inflation defined as the deterioration in the purchasing power of the US dollar relative to the basket of goods and services acquired by US families. By that definition, I would suggest to you that the purchasing power of the US dollar is declining at about 8% compounded. A real interest rate then would mean that the US 10-year Treasury would have to yield some number in excess of the rate of deterioration of the US dollar. The US 10-year Treasury right now yields about 4.5. In the circumstance that would cause me to sell gold, the US 10-year Treasury would have to be yielding 10 or 10.2 or 10.5, a circumstance that I don't think will occur. I think as a consequence of negative real interest rates, on balance sheet liabilities and off balance sheet liabilities, and the need to print to honor the nominal, not real value of those obligations, that the purchasing power of the US dollar declines by 75% over 10 years. And at least the nominal gold price likely mirrors that decline over 10 years.
Okay, and how do you see? So if you look at copper, that's generally there's a copper gold ratio that everyone looks at. I think it's a record. So basically, yeah, gold is a record sort of highs versus copper, and that's because of the economic weakness. Do you see that continuing?
I don't look at the ratios. I think they're interesting for generating commission or selling newsletters, but I think they're different asset classes. I certainly understand that inflation of the type I'm talking about will increase the cost to produce copper, and in particular, increase the capital cost of putting in place new copper infrastructure. Assuming that demand doesn't falter, that will obviously have an impact on supply and an impact on cost. I'm a copper bull. I'm a copper bull for a couple of reasons. We have underinvested in copper, copper exploration, copper development, that kind of thing, for 30 years. And you can't undo that sin overnight. We are in a supply deficit now, and demand for copper, almost irrespective of any other factor, except a global depression or deep recession. The demand growth is assured. In the West, we think about things like AI and electric vehicles. What we think about less in the West, because it doesn't affect us, is the fact that 1 billion people on Earth have no access to primary electricity. They're going to get it in the next 20 or 25 years. That's going to require a ton of copper, metaphorically, many tons of copper. Copper for generation, copper for transmission, copper once the wire reaches the home for utilization. Copper demand is insured for a very long time, and copper supply will be short, irrespective of the gold price. The impact of inflation on copper needs to be considered too. We are going to have to build a lot of copper mines in the next 15 years. And the cost of developing those copper mines, at least in nominal US dollar terms, isn't going to go up, it's going to explode. What is today a $7 billion or $8 billion upfront capital expense to build a South American porphyry is going to become in very short order a 10 or 12 or $14 billion upfront capital expense. That means that existing long-lived producing assets are worth much more than people think they are, because you obviate the necessity of the upfront capital cost.
Yeah, it's a great point. Do you not see? I guess it's different in oil and gas. It seems like the cost of production is going down after the inflation seen in 2020s, early 2020s. I'm guessing this will go up because there isn't going to be an oversupply of the market. There's going to be high demand for new mines coming online.
The price of oil has, I would say, moderated and in fact declined in real terms a lot in the last 30 years, and that's really a function of technology. It's a function of four-dimensional seismic, directional drilling, multi-stage fracturing, more intelligent use of frac fluids, this whole shale revolution, and particularly the shale revolution in the United States and Canada, where there was a political and social sophistication that allowed its utilization. Unless technology improves markedly, our ability to use these now legacy technologies to continue to increase supply is faltering. Secondly, for at least 5 years, the industry on a global basis, including in particular state-owned firms, hasn't invested enough in sustaining capital investments. One of the reasons why the costs of producing oil has fallen is because the industry is not making the same level of sustaining capital investments that they used to. The International Energy Agency estimates that the global oil industry is underinvesting in sustaining capital investments to the extent of $2 billion a day, which is to say over $700 billion annually worldwide. This doesn't impact the industry's ability to produce oil in 2025 or 2026, maybe even 2027, but it has an ugly impact if it's sustained into 2028. Ugly for those companies and ugly for the consumers. Beautiful for the companies that are efficient producers today and continue to make the sustaining capital investments necessary to maintain their production in 2028 when other producers' production inevitably falls.
Okay, yeah, great point. If we maybe take a step back, and you mentioned that the only time you sell your gold is if they resolve the problem of deficits. Do you see that any chance of that ever happening, or it's impossible?
We in the United States dealt with it at the end of the decade of the 1970s. We allowed the interest rate to rise to market levels, which is to say 18%, which broke inflationary expectations, broke a lot of people too. And while we didn't reduce the size of government, we reduced the rate at which government increased. The Reagan Revolution, despite its sort of vaunted anti-government stance, was derailed by politics. We didn't reduce the size of government at all, but we reduced the rate of growth of the US government in the period 1980 to 1992 fairly dramatically. That allowed the economy to grow at a pace that was more able to afford our collective stupidity. And I suspect what happens in the next 10 years is not dissimilar to what happened then. I expect ultimately that the market will get in control of the long-term interest rate, not the Fed. That'll have fairly profound implications in terms of the cost of capital. And I believe that 10 years from now, I hope, we will slow the rate of growth in government expenditures and hence government debt. I think with regards to entitlements, that we will reform entitlements. I think as an example with Social Security, they'll say to some fat old rich guy, Rick Rule, the idea that your taxation for Social Security ends at $160,000 income is going to go away. You're going to have to pay in just like everybody else at all levels of income. In other words, there's going to be a huge tax increase for productive shareholders, productive taxpayers. The second thing that happens is they're going to look at me and they're going to say, no matter how much you put in, we're going to means test it because we can't afford to pay you. So there's going to be a straight transfer in Social Security where they steal money from folks like me in terms of how much they tax, and they don't pay them anything. That's called theft. That's going to happen. The other thing that's going to happen, and it should happen, they're going to means test all entitlements, but they are going to increase the eligibility years in Social Security. When Social Security was instituted in the United States, it was meant to provide poverty level income from age 65 on. That's an important stat because the average life expectancy of an American male at the time they instituted Social Security was 66 years. So the program was meant to sustain the average American at a poverty level of existence for 1 year. The average life expectancy of an American male is much longer now. The consequence of that is that the eligibility years for Social Security needs to go up. It needs to be expanded from its current 62 to perhaps 70 or 72. That needs to happen. And I think over the course of a decade, not over the course of 2 or 3 years, but over the course of a decade, that will happen.
Yeah, it's a great point, and I know that's something that they do in other countries, in Australia, and I guess the challenge is that they've already, that's been laid out for quite a while, and it's different when you're sort of changing it after many of these people have retired and potentially relying
There's a
on it.
lot of Australian governance that I would criticize. I've invested in Australia for a very long time. I enjoy the place. I enjoy the people. But the Australian superannuation system is vastly superior to the US Social Security system.
Yeah, mining and oil and gas is definitely not a good part of the regulation of Australia. But anyway, so Rick, thanks so much for your time today. I really appreciate that. We've covered so much. But my last question is, what is one message you want people to take away from our conversation?
I would say focus on arithmetic. Pay attention to your investments. Pay attention to the arithmetic in your future. Be disciplined. Do the work. I'd like to help your audience do that. To the extent that people like what I have to say about natural resource investing in particular, I do natural resources and conventional financial services. I'll help for free. Go to my website, ruleinvestmentmedia.com. Once again, ruleinvestmentmedia.com. List your natural resource stocks, and I personally will rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value. From there, I will introduce you to the Rule Classroom. You can use it or not. 15,000 people do. It's free. There's 220 something hours of instructional programming. There's also a few free Q&A every week that I'm available. That's Rule Classroom, absolutely positively for free. There is an enhanced subscription-based service, but try the free one first. See if you're going to use the subscription-based service. So Rule Investment Media for rankings, Rule Classroom to learn how to invest.
Great. I'll put that in description below, but thanks again for your time.
Thank you, as always.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.